Hey everyone, it's Imran from Options Insight, and I'm back with Trader Chats. And these roundtables are starting to get a bit more traction. We call it the Macro Avengers. Obviously, we've got good old Darius Dale here as our resident Hulk. God knows who everyone else is, but I'm going to introduce them by their proper names. This panel is a big one. I've got Alf Peccatiello here from Macro Compass, Tony Greer from TGMacro, Brent Kochuba from Spotgamma, and now I've got it's an honor for me to meet Kuppy for the first time from Kedem. How you doing, guys? Thanks a lot for being here.
Hey, thanks for having us.
Let's go, man. It's a pleasure, man. It's great to be here with everyone. You guys are awesome.
So, Macro Avengers, last time we all got together was for Q4, and I think we were decidedly quite bearish as a collective. Markets managed to kind of not absolutely fall out of bed, but we didn't get the stand to rally either. So I think we'll call that one a scratch. But since then, it looks like the landscape may have changed somewhat. You know, inflation, the inflation picture rolled over maybe a bit quicker than a lot of us were anticipating, and we're starting to kind of reevaluate our outlook on recessions and things like that. So very, very interested to hear what everyone has to say today. But because there's so many of us, I'm going to try and keep it relatively brief in terms of the number of topics we're going to cover. So why don't we kick off with the first topic, which I think is on everyone's minds in macro, is about the Fed and the rates market. So the rates market's obviously pricing in cuts starting in later this year. As you know, and those cuts are likely to get more aggressive into 2024 if we look at the euro dollar curve. Whilst the Fed communication is insisting higher for longer, right? Terminal rates hit just above 5%, and they stay there because they want to get that inflation genie well and truly back in the bottle. So how does this conflict get resolved? For me, that is the number one question for this year, and is going to help map out what risk assets kind of do and when they do it. So why don't we go with tradition and start off with Darius. Welcome, mate. Why don't you give us your sort of thoughts around that?
Oh, yeah. Appreciate you, man. Thanks for letting me bat off. So let's see if I can get on base. I would say in terms of the resolution of that awkward mispricing we're seeing in the rates market, you know, I think it's going to come in sort of two stages. The first stage, in my opinion, is when the going really starts to get tough economically. And our view is that a recession continues to be a second half event rather than a first half event in the U.S. economy. When the going gets tough, the Fed is going to be sitting on its hands with respect to monetary policy. And this is likely because of their forecast, which implicitly call for a recession to begin developing sometime in 2023. And so it's unlikely that they're going to be sort of surprised by the data in a way that would necessitate easing. And so ultimately risk assets are going to have to kick and scream like a kid throwing a tantrum in a toy store in order to get what it actually wants from the Fed, which is rate cuts and QE. So we would expect asset markets to perform quite poorly starting around the middle of this year into the back end of the year in order to perpetuate that real full policy pivot.
Okay. Who wants to go next? Alf, I know you've been looking at, you know, credit impulses rolling over and, you know, the jobs market going to start to crack in the not too distant future. I mean, do you think it's a case of they're actually going to have to start cutting like the market's pricing and actually go even harder than the market's pricing?
So let's first clear out one thing. The bond market isn't pricing a recession.
Agreed.
If you look at credit, vol, and what the Fed does in a recession, the Fed cuts 400 basis points. In 2001, they cut 475 basis points in 15 months. That's a recessionary cycle. The Fed cuts below neutral in a recession. Otherwise, what recession is that? You can't keep Fed funds at 3% like 2024 SOFR or euro dollars are pricing today. That's not consistent with a recession. In a recession, you cut rates to 1%, 1.5% minimum. That's a cutting cycle of a recession. Credit, la la land. High yield spreads 420 basis points. In a recessionary cycle, it's 800, 1,000. Vol in credit space, Imran, you also look at that. Its skew vol is completely relaxed. It's nothing to do with any investor buying serious downside protection for a recession, credit cycle in a recession. So let's clear that out. The bond market is pricing disinflationary, la la land, soft landing outcome. And that's reflected again in credit and in the bond market. assuming that inflation comes down, if you look at inflation swaps, you're talking about 2.5% inflation by September. Whoa, that's quick. But that doesn't come with a credit cycle. So the market is like, okay, relax, looks good. On that backdrop, I think there are two risks. One is what Darius highlighted, is that the Fed is going to be stubborn. If there is one risk management practice the Fed is going for, is making sure a repeat of the 70s isn't here. So premature loosening of financial conditions, blah, blah, blah. We're going to fight against that. Otherwise, animal spirits, and it's all going to restart, and we don't want that. So that's the first risk. And the market is underappreciating that, as in higher for longer is priced as a 15-20% probability scenario today. Second risk, which is underpriced, is a recessionary cutting cycle. Credit space, not equipped for that. The bond market, when you look at convexity, is also not equipped for that. So I think the base case is soft landing, this immaculate disinflation. And I think it's becoming too much of a base case being priced in. The tail risks on both ends are underappreciated. That's how I look at it.
Mm-hmm. So you're not necessarily willing to make a call on which one we're going to get, but saying that the base case scenario.
Oh, no, sorry. Otherwise, it looks like I'm really a macro blubber. The call is that we get the recession by May, June 2023. That's job losses and negative earnings growth. So it's going to resolve with the second tail becoming a base case, let's say. I was just illustrating market pricing like a proper macro blubber, and now I'm trying to make a call.
Okay, so that sounds like you're in the opposite camp to Darius, right? Darius, correct me if I'm wrong. You're in the camp that the Fed's going to say, screw you, we're holding rates here because we don't want that secondary wave of inflation that we got in the 70s. We don't want that. So we're going to nip this thing in the bud. And actually, we've been warning you that a recession's coming. So what do we need to do? Right? Is that fair to say?
Yeah, I don't know that we're in the opposite camp. I think we both agree that the Fed is going to be stubborn at the beginning of what we've been calling the phase 2 credit cycle portion of this bear market. If you look at the Fed's forecast for PCE, the implied delta there, or their forecast for the unemployment rate, those implied deltas between year-end 22 and year-end 23 imply that the Fed is already effectively forecasting a recession. If you look at the deltas there, that we've never seen such deltas outside of recessionary conditions in the U.S. economy. So it's our belief that at least in this, kind of early innings of the recession, first couple of quarters maybe, that the Fed is, just sitting on its hands. And that's going to result in an effective tightening of monetary policy relative to the baseline, relative to, more neutral measures of Fed funds rate at those particular junctures. Okay,
let's get the other guys to weigh in and see where they sit. Do you want to go, Tony?
I'll go really quickly, Imran. I don't have a particularly strong view. I'm a kind of a spectator in the rates market, and everybody on this call probably has a better understanding of the bond market than me. So I'll be brief. The way I look at the market is a little bit different than everyone else. I think, I'm looking at the fact that we had 2 negative quarters of GDP growth. Looks like we potentially had the beginning of a recession in the rearview mirror. We've got the curve inverted at like 65, 75 basis points and 2s, 10s. For me, that's kind of when I'm on the lookout, looking for waterfalls in the S&P, potentially disastrous economic data. So while I think that a little bit of that is coming, I still think that the commodity rally at some point is going to take hold this year, keep the Fed's hand to the fire in terms of staying tighter rather than pivoting toward a dovish stance to combat a slower economy. So I'm still on the commodity inflation side. I see rates as consolidating, and I see the negative yield curve as sort of a warning sign for me as to what could be ahead for the economy. And that's really all I have on this issue, Imran.
Thanks, man. No, that's all good. What about you, Kuppy? What do you think?
I think I'm going to say that I know less about rates than Tony. He just said he knows nothing.
That you made about inflation, though, all right, making it harder for the Fed to turn. You agree with that?
Oh, absolutely. But I would take that in a different direction, say that by Q3, Q4, the energy crisis will be here, full blast. And, we topped out last time in the 120s, this time last year effectively. And right now we're lapping that. And as a result, inflation's moderating, I guess. And I think as oil starts, breaking out above that level and to new levels, I just think that it's going to force the Fed's hands. And the Fed is effectively going to be chasing oil across the screen. And I think everyone's, thinking that, inflation moderates. And I don't think inflation moderates if oil has a two handle. And so that's kind of where my head is. I just don't know if that's a Q3 or Q4 or a Q1 next year call. But you can't have a 5 million deficit daily. And eventually you just drain the inventory and the price responds. And the way you solve a 5 million deficit is you destroy demand. And you don't destroy demand here in the high 70s, low 80s. And so I think you see a much higher price of oil. I think that becomes the what drives the markets for the rest of the year and next year. And the Fed, they'll do whatever the Fed does because, they're just government bureaucrats in the end and somewhat unpredictable. But I think oil's more predictable. But I don't know. That's kind of my view.
I don't have anything to add on the rates side of things. I kind of ignorantly just continue to watch the MOVE index, and that thing seems pretty stubborn. And I continue just to think that you don't want to buy equities or really get materially long equities until that rate volatility comes down. So for my, rather simple seat and options land here, that's what I just look at. And I'm actually curious if I could kind of pose a question to everybody. I mean, I think whether or not a recession comes seems to be up for debate. I think we all kind of feel like one is coming, but you kind of shift now to this issue of the debt ceiling. And that seems to be kind of the next shock that may come in terms of moving into June. And I'm curious kind of what people's view of that is, if that's sort of like this thing that everyone's starting to price in already, or if that is really a material risk to the downside. I've heard Darius recently talk and listen to some other guys like Dan Spring talk and say that, hey, look, this is this thing we're going to have to deal with at most by June, kind of late Q2. So what's sort of everyone's feeling about that?
Darius, do you want to jump in?
Yeah. So I don't know that I'm particularly non-consensus here, but it's our belief that the debt ceiling ahead of the actual political battle that we're likely to see, kind of intensifying around May and June of this year, is probably going to be at most a slight bullish catalyst for the markets, at worst probably a neutral catalyst. And a couple of reasons for that. One, we've seen Janet Yellen sort of accelerate T-bill issuance as part of her cash management technique in recent months, so much so that we've seen a pretty significant retracement in a deep negative spread between T-bill yields and money market rates. And so that increased T-bill supply has been sort of flattering the reverse repo facility balance to the downside and ultimately inflating that liquidity. And secondarily, we have, still $471 billion in the Treasury General account balance currently. That's probably going to go towards zero over the next few months. So those two factors combined are likely to combine to offset the Fed's quantitative tightening program. And so you could get a slight, kind of upward drift in net liquidity throughout the next, let's call it 4 to 5 months before ultimately the debt ceiling drama. And there will be drama if you read the tea leaves of this in terms of the Republican Party and the Democrat Party. This is very similar to 2011. You go back to 2011, you had a Democrat president, probably did a little bit too much fiscally. Then you had the conservatives come in and kind of take the Republican Party hostage, a small faction of uber conservatives. And that's very similar to the setup that we have here. And ultimately, they're going to demand concessions that the Democrats are probably not going to want to give, given how few concessions that they threw, that they had to throw in terms of Donald Trump's raising of the debt ceiling 3 times throughout his presidency. So I think it's probably going to be a slight bullish catalyst on the way there. But ultimately, it's going to become, a market-moving event, in our opinion, once we actually get into the political wrangling. And oh, by the way, on the other side of actually raising the debt ceiling, you're probably going to have a significant significant decline in net liquidity vis-a-vis the rise in the Treasury General account balance. So kind of sets up for a tale of two halves.
Yeah, so I've read the same around the net liquidity function and that turning up. And I guess your best sort of indicator there, or one of the things that likes to move on net liquidity, is crypto, right? And crypto's caught fire in the last few weeks, right? As that news has started coming out, and the idea of the TGA drain going to zero, effectively cancelling out QT for the next few months. So that's definitely the narrative that the crypto market seems to be going after. Anyone got any thoughts on that? The whole idea, because I know, Alf, you put out a piece about liquidity like today, right?
Liquidity is a strange beast. It's bank reserves, basically. It's money for banks. More money for banks means more lubricant for the repo market, more lubricant for the bond market, and that it basically allows other asset classes to trade tighter. It's a bit like the bond vol story that Brent was referring to before. When you have bond vol lower, then normally large asset allocators can allocate more extensively to other risk assets. And the same story goes with bank reserves, right? A rapid change in bank reserves helps or doesn't help financial assets. Darius is right that if you draw down the TGA, mechanically you'll have more reserves in the system. Yes, you do. It's just an accounting thing. It's we're not discovering anything new here. But there is one angle that I find interesting is there are two more mechanics in this reserve story. One is the reverse repo facility, and the other link to that is what are households doing here? Because if households take their deposits away from the banking system and start buying T-bills, they allocate into money market funds. They're literally taking away deposits and money from banks. They're draining the banking sector by choosing to allocate money away from JP Morgan accounts yielding 0.5% at best into a money market fund, which is the same exposure. It's short-term liquidity exposure yielding 4.5% for fuck's sake. Can I say for fuck's sake? Yeah, probably I can.
So you like, mate.
So that's a 400 basis point risk-free pickup by just doing the same thing, buying T-bills or putting money in money market and funds. But what happens mechanically when that happens is deposits are taken away from the banking sector. I'm taking my deposit literally away from JP Morgan and I am buying a T-bill. I'm putting money in money market funds. So reserves can also be impacted by the behavior of households and by what happens in the reverse repo facility. It's not an easy picture. Overall, I think, yeah, probably the drop in reserves is going to be less acute than people think over the next 3 months. And Darius is right there. But what happens after that? When we solve the debt ceiling, we have to replenish the TGA. So it's a double whammy later on, because QT keeps happening. That doesn't stop. On top of it, you'll have to replenish the TGA. So, well, short term, if you want to try and chase this move up, fighting both Powell, that doesn't want animal spirits to be back in the market, and fighting the fact that when you replenish the TGA, you have a double whammy negative bank reserves impact. I wish you the best of luck.
You could also, if you also look at, I know this is a little bit different than the net liquidity story, but if you also look at just E-mini liquidity in the S&P, it's also still terrible. And I still feel like you're going to get, volatility is going to remain until whatever the cause is for assets to just shift back in and just overall market liquidity in terms of just basic bid-ask depth improves. It's still really kind of garbage. And so, the thing I was curious about with you guys, and we kind of had the story today, is like the market seems to rally into all these events. Like we rallied into CPI last week. We rallied into CPI in December. We're like threatening to rally here into FOMC next week. And it's like, what is the impulse there for the market to rally into like the event? Like I liken it to the akin of like spending your lottery winnings before you've actually won the lottery. It's like, what's the aggression? Is it just people trying to miss the tail move? Because that seems like it's not only an equity phenomenon, but it seems like rates shift ahead of the actual event as well.
I think it's a bit short covering a lot of the time, right? Because I think everyone's quite underweight, right? In general, they've had a year to realize that the world is not looking great and a recession's around the corner. So we know that discretionary managers in general have been quite underweight. But we've seen when you've had disinflationary data, S&P ripped 5% in a day. So when you're massively underweight, you're kind of like, you know what, I might want to get past this data point and not get my face ripped off, right? And then I can go back to where I want to be. So,
right.
So I think you're seeing that. I see in the run up to these data points that we know can be quite market moving and material for the reaction function or whatever it is. People cover those underweights. They buy a bit of delta, they buy a bit of call optionality, they let the data point pass, and then they go back to where they want to be. Yeah. Anyone else agree or disagree?
Imran, I couldn't agree more, just because I feel like, that's a little bit about kind of how the Federal Reserve is guiding you, right? I mean, they're guiding you toward, they're keeping rates higher. We've seen recession and everybody is positioned. It seems like the vibe that I get from my Twitter feed is that the recession is imminent and pending and severe, and therefore the stock market must go lower. And so everybody is going to be positioned for that. And I think that, that's why when things get running on the upside and they get above moving averages, everybody realizes that they either have to get out or they have career risk. And if they don't keep up with the market, they're not going to be able to be there. So that's why I think we have this non-linear fits and starts with rallies and then waterfalls and then rallies through the moving averages and then waterfalls. So I do think that people are positioned drastically the wrong way right now.
Anyone else got anything?
Is it positioned the wrong way, or is it more just under allocated?
But yeah, I was going to say that it may be fair to say under allocated.
Yeah, it's kind of the same thing, I guess, right?
Well, if you're long a whole bunch of stuff and you're worried about the world ending, you gotta hedge differently. You gotta do a bunch of different things as opposed to like, I'm just worried about missing the right tail. I think it,
which is a bigger risk for institutional investors than missing the left tail.
Yeah, and Darius, I saw that Fidelity credited Morgan Stanley with your net liquidity tool, so you let the cat out of the bag with that one.
That's all right. I had a conversation with them afterwards.
All right. So let's move on to the next thing that everyone's scratching their head about, and it's I'll put them together, right? Commodities and the dollar. So obviously, China dropping COVID zero was a massive catalyst for commodities coming out of the gates this year. But then the weaker dollar that we've seen top out late last year has also been a tailwind, right? And that's why we've seen that's lit a fire under gold. Gold's looking really strong. I haven't heard anyone that's bearish on gold. That's what made me buy put spreads like 2 weeks ago. Clearly that didn't work. Yeah, but I don't know anyone that's bearish on gold right now. But yeah, so what do we think with regards to that? Obviously, metals have really caught fire. Energy's been lagging somewhat. Obviously, we know Kuppy's calling oil to 200, Q3, Q4. But I think the dollar's a big one, right? On this commodity story. Do we think the dollar's topped? What's the logic there? Some people are thinking it's oversold right now and needs a bounce, but structurally, maybe it's topped. What do you guys think?
With two central banks up at the top in the Bank of England and the Bank of Japan, I think the high is in the dollar. I think those were two really, really, telegraphed events last year where, the dollar strength at a period of time when nobody thought that it would even dip a basis point. We broke the gilt market. Bank of England intervened and it backed off a little, came roaring back to 150, and the Bank of Japan intervened, and that was it. And now we're, cascading lower between moving averages. For me, the dollar moves in sort of has behavior on the year. And we watched it consolidate in 18 and 19. We watched it sell off in 2020. We watched it rally in 21 and 22. And it looks like it could sell off for all of 2023 if you look at the chart. That's just how that's my view, and that's how I'm looking at it.
Mm-hmm.
That was a good high. That was a good high, and it did change the direction dramatically. And I think the dollar can head lower now.
Anyone agree? Want to agree or disagree with him?
I want to hear Kuppy.
Yeah, I was gonna say Kuppy. He probably had the best view on this.
No, I actually don't have a view on the dollar at all. I've never really traded currencies much, and when I've tried, I think the smartest thing I've ever done with currencies is just go visit, and if it's kind of cheap to get a beer and a burger, it's a good currency to buy. If it feels expensive, you sell it. And I'm not joking. Trading. But it's usually
everything's
about
a value play for Kuppy. That's it.
I remember I was in Australia and the Aussie dollar was like 105. And I remember thinking to myself, wow, this is like London pricing. And that was pretty much the top. And it just never had an uptick since. And,
I like that.
I was in Europe and Euro was under parity. And I was thinking, wow, this is really cheap. This is like going to Mexico. And, it's been, up almost 15%. And I don't know. I think that's just how I think about the world. But I don't think you could trade off of the price of a beer.
All right, but let's stick with what you do have a strong view on, which is commodities, right? So, what are your thoughts on gold? Are you in the gold bull camp? And I know you love energy, but let's talk about nat gas for a minute, right? So, nat gas is falling through the floor right now. I mean, next support I see is like $2.50 or something. But my God, that thing has got cremated, right?
Yeah.
So, is this thing ever going to catch a bid again, or talk us through your kind of energy thesis, where you are in metals, where you are in commodities in general, because I think you and Tony, I think everyone's dying to hear, what the setup is for commodities if it's going to be a big driver this year.
Well, I'm just long-term bullish commodities because they're going to be forced to print more currency, and all the other central bankers will do the same. And right now, it's a weird moment in time where they're trying to stop the global economy, but politicians mostly focus on stimulating, and I assume they'll go back to stimulating because that's a lot more fun, and you get reelected that way. And I think you should be long-term bullish because they're going to keep stimulating, but no one's building any more mines or oil wells or really anything else in commodity or, refining or petrochem. Just nothing's being built. And that's not sustainable if demand grows every year with the global economy and global population. Do I have a view right now today? No. I mean, I don't think anyone really knows what the weather is going to be in the US. So how do you trade nat gas? And I mean, there's a bunch of guys on Twitter that have all these, it's like a Rorschach test of cold weather coming. And I look at it and I don't know, but they don't seem to make any money either. So I don't really know nat gas. Gold, look, gold's going higher because they're going to debase the currency. Will gold keep going higher? It's up almost $300 in a straight line. Gold usually retraces, but it's probably going higher. I feel much more strong about oil just because we're probably going to still have slight builds for the next month or two, and then we're just going to start draining, and the draining won't ever stop. And I feel the same way about uranium, where I think the deficits are actually going to expand this year and expand dramatically, and understand and protect. And I find that most people in finance tend to anchor their price targets based on the 5-year range or so. And sometimes these things have horrible supply-demand mismatches, and it dramatically overshoots, and it catches guys off guard, and it tends to be when you make money. And so those are the two commodities I'm really excited about because they have massive deficits. And you just go where the deficits are if you want to be long a commodity.
Yeah, I mean, on the uranium story, I've been long uranium for a while. I've agreed with that thesis on the supply demand, but I guess the frustration on that uranium trade is when the hell is it going to blow, right? Like, I mean, as in everyone knows the story, everyone knows that there's this massive deficit. So what is it that's preventing this thing from really taking off? That's what makes me kind of scratch my head and be like, well, we all know they have to go that way. We all know there's not enough of this stuff. Why is it not flying yet? Like, any thoughts on that?
Because it highlights all of the weakness in the ESG policy, right? I mean, if they're trying to switch us over to wind and solar power by, via battery power, and they make instant admissions that we need nuclear to compensate for the power that we're not getting from wind and solar, it's like an admission that they're running a scam. You know what I mean? Okay. If we go piling right into nuclear, I think they got to kind of beat it back and slow walk us into the nuclear. Like, well, we can't go back to fossil fuels. We're going to have to go to nuclear, but we got to win public support. That's how I see the story.
I'll tell you what's missing to answer the question. It's $200 oil. There will go nuclear when we have $200 oil. It's just we have to wait for that catalyst to occur.
I mean, that's what made Europe basically pivot when, they had the functional equivalent of way higher $200 when you look at nat gas and TTF. Everyone could be righteous about carbon until, the heating bill goes up, and then you become a realist.
Totally.
But
Speaking of carbon.
But for your question about what's happening, sometimes these things just take their time, and markets are there to chew people up and grind them and shake your conviction out of a trade, and then it goes. And I just know that if the price of uranium goes above 60, is every hedge fund, every trader, everyone knows the story. If it goes above 60, it's just going to panic gap to 90 because everyone's going to pile in. You're going to find an air pocket. There's some warehouse somewhere, and they're slowly draining the uranium. And when they finish draining the uranium, they're going to run out, and it's going to just gap away. And that's the moment that the utilities wake up and everyone else wakes up. I mean, that's why you have breakouts that just continue. And so I think you have to be positioned before that, not after. And I got to say, that chart looks really, really good. It's a 1.5-year consolidation, just sitting under $50. So I don't know. That's me.
Yeah,
Tony, you're the chart guy. Do you agree?
Yeah, I'm really bullish. The sector uranium chart URA. I mean, that's just a gigantic pennant flag with a 2-year-long bottom at like $18.50. I mean, that trade is so up my alley. So I just added it, and I'm with it, man. But I think it's going to be fits and starts. I don't think that there's going to be a full admission where it's very clear that we are transitioning toward more nuclear power. I just don't think that they're going to make that obvious. You can, though. You can lean on the fact that, like Pozar just said, that, it's probably more important for us to pay attention what the heads of state are saying than central banks are doing. And that's the mode that I get when you watch Kerry at the World Economic Forum, and we're really just stepping on the net zero gas into low inventory commodity markets, and the Fed is just forced to deal with it. Right, the Fed's got no choice but to deal with the fact that we had $5 gas, and we had $300 per megawatt, 300 euro per megawatt hour electricity in Germany last winter. And if they didn't get bailed out by weather and throwing $500 billion at the problem and buying natural gas up to $8 to fill their storage, there would be a serious problem in Europe, right? If the weather stayed cold and things like that. So, I think that this is going to be a recurring issue and a recurring crisis in energy. So as long as the politicians continue to lean on the gas and we've got to get to net zero faster, those are the things for me that say that I can stay in the fossil fuels markets and stay in uranium and just wait for it to happen.
On the whole ESG thing, do you like these carbon allowances, this KRBN thing that people have? That was like the best Sharp ratio trade I ever saw for about a year. It was unbelievable, right? But it's the one that Raoul Powell got everyone into a couple of years back. And then they got out of it, but they've been talking about getting back into it. And I wonder, does that pair up really nicely with a long uranium, long oil type view to own some of those carbon permit things? Well, I don't think they're permits, they're allowances or whatever they call them. But have you got a view on that trade? Because apparently, Kuppy, you at one point said it was a bit of a Ponzi. Because I don't know why I didn't see that comment that you made.
Well, I mean, I have the same view. If you create if you use a bunch of laws to create a product that has no economic value, well, I mean, the politicians, if they created this market, they can kill this market. And if energy prices are sort of benign, there's no incentive to kill the market. If energy prices go up, they're going to print more of these things and functionally kill the market. They're going to hand all the people out, carbon credits. And so why do you want to be long carbon credits? Because if you're right, they're worthless. It seems like a dumb trade. But that's just my view.
Yeah. Well, that's why I think it might work well. That's why I think it might actually work well, at least temporarily work well, as to be coupled with a long uranium type trade, right? Because, you might have a situation where uranium kind of doesn't do a lot, but these things keep trending up. But you're right. The problem with them is liquidity. We saw that last year, right? It's like when everyone wants to get out at the same time, it's down 20% in one shot and you can't get out. So that's the risk.
I mean,
right?
the problem is that you just need some junior minister somewhere to say, hey, wait a second, let's print more of these things. And it's down limit forever. And the whole faith in the whole system's broken. And if I know junior ministers, well, they want to become senior ministers. So they go out there and get noticed. And that way, they improve their political capital. So no, I think you're just playing with inherent volatility there for no reason. I feel pretty strongly that in 5 or 10 years, these won't exist.
Interesting. All right, that's good. I'm pretty sure we answered that question for the people who wanted to know. Okay, and then copper, things like, well, I mean, I know you're generally just saying structurally be long, but this China reopen narrative that's kicked in this year, I mean, it's had a pretty fast impact on some names like copper and things like that. Do we feel, I know you guys don't like to you're talking longer term, but from a tactical perspective, do you think it's overdone right now? The whole China reopening narrative, the commodities ripping higher, do you think it's going to have a breather or not?
Well, that seems to be a hard question, so I'm going to take it. How can you reprise the reopening of the second largest economy in the world with pent-up fiscal stimulus sitting on the balance sheet of consumers that were locked home for 3 years in 3 weeks? That'd be pretty quick, especially as when I was in the business of running institutional money, first-hand experience, if you have to allocate somewhere and it was for some reason politically uninvestable, basically China in 2021, 2022, the CCP was telling you can't be invested here, no real estate, no tech, fuck off, basically, just as a summary, right? It's not very immediate that your risk manager has probably frozen your limits, 99%. It's not immediate that you walk to your risk manager like, hey, dude, they have reopened. I need to buy all the Chinese renminbi and risk assets right now. And the guy would be like, nah, wait a second. Let's have a committee. Let's talk about it. And it takes a while for this. Even the EM specialist, I think, to reallocate from Latin America, which was D-trade last year, Mexico, Brazil, all these carries and all that stuff, To reallocate to China, it takes time for institutional investors. And also it takes time to digest what it means. We haven't even seen it in the soft data yet. I mean, like South Korea exports, typical high beta macro data to China, haven't barely picked up yet. I mean, it takes time to reflect in soft data first, then in hard data, and then finally people will, I guess, pick up. Another way to say it is, I don't know whether you guys are familiar with the work of Ben Hunt, Epsilon Theory. So Ben, I think he did a very good podcast with Mike Green a while ago, where he said, yeah, what page of the newspaper is the trade? Is it page 10, page 6, page 1? And I think China is, page 3, used to be page 10, but now it's much more widespread as a discussion topic. But is Bloomberg making a daybreak about that, with fund managers saying, screaming that everybody needs to go long China? Not yet, maybe, not yet. And commodities are a beta play to China, like base metals are a beta play. So there is even an additional layer of that. So I think we're page 2 or 3. So we're getting there. We're not there yet. I've been at a very large investment bank conference in London 2 weeks ago. Large asset allocators in the room. It is definitely becoming more consensus. If you ask them, it's like, yeah, well, long yen because they've already hiked, because China is reopening, because da-da-da-da. So it's becoming more consensus. But have we done all the repricing yet with all the institutional money flowing back there? No, I wouldn't say so yet.
Mm-hmm.
Yes, I would just hop on and echo that sentiment. One of the things we track is sector and style factor dispersion on a month-over-month Sharpe ratio basis as a proxy for pod shop style flows. And we saw the breakout to cyclical leadership a few weeks ago. So that sort of augments what Alf is saying in terms of this, really starting to become a more noticed story, but not necessarily a page 1 story. When you look at the time series of the dispersion, we're still technically trending in defensive leadership territory. And so if you really kind of put your mind together on a full scale Chinese reopening policy plan with stimulus, that's going to get, trending very cyclically by the end of in our opinion, by the end of the first quarter, or perhaps, well into the second quarter. And not to mention, you should continue to see this break down the dollar. It's kind of, in my opinion, one of the least talked about things in all of global macro, which is ironic because the dollar is, global macro. The dollar has broken its longer term trend. If you look at the Fibonacci retracement levels on the bull run from Jan 21 to the September 30th high, or the end of September high, we have broken past that 50% retracement level. And so that now tells you we're in a real structural bear market in the dollar. And the only reason you ever have a structural bear market in the dollar is because global growth is improving. It's the residual of the supply and demand of global credit. And why is global growth improving? Well, you have the world's second largest economy coming out of lockdown. That's a positive growth impulse, but they've guided to some pretty material fiscal monetary easing programs, of which China tends to congregate its fiscal monetary easing in the first quarter. 2/3 of the time, whenever they have an easing program, the impulse tends to peak in the first quarter, with obviously a tail in terms of the lag with respect to how it hits the economy. So it's our belief that this move that we're seeing in base metals, this move that we're the bottoming process we're seeing in energy, obviously the cyclical leadership, the cyclical sector and style factor leadership within the equity market, that stuff is legitimate. And I think the market had to go from pricing in a 0% probability assigned with that to something that's a lot closer to 100% probability assigned with China reopening and stimulating. But ultimately, it'll become something that's less relevant for financial markets as we move forward in time, and the U.S. economy and the Fed's reaction to deteriorating U.S. economy takes the baton away from China. But China has the baton right now.
Mm-hmm. Tony, you got anything to add there?
Nah, I'm taking it as it comes. I'm enjoying. I like the points that Darius and Alf both made, and I'm learning from that and just kind of absorbing right now. For me, it's still the charts look good. The dollar weakness that I believe in is going to be a tailwind to my commodity bullishness. The markets have held where they had a hold last year and should be advancing this year, seeing how the supply deficits are intact. So nothing is going to be linear, but that's still the trade that I'm hunting.
On the SPR, they finally stopped dumping barrels onto the market now, right? Is that right? I heard
there was none. There was no SPR release last week, so there is, I believe, none on schedule to be released at the moment. So we're waiting right now to see what the next move is.
Mm-hmm, mm-hmm. Okay. Anyone got anything to add on this commodities and dollar theme, or should we move on to our third and final?
Oh, one final thing I would add on commodities and dollars right now. If you look at overnight index markets like money markets, they're pricing in the ECB to hike by an additional five rate hikes more than the Fed hikes in 2023 over the next year or so. And so, in our opinion, I think this China reopening story is not only a positive for or negative for the dollar in terms of improving global growth dynamics, but it's also a negative for the dollar in the sense that, as long as global growth is improving, and we have seen sequential improvement in the European leading indicators since, let's call it October and November, as long as that is getting better at the margins, it's going to give Madame Lagarde and her colleagues at the ECB more confidence that they can, kind of keep going with 50 basis point rate hikes, et cetera, for longer than I think, markets probably initially estimated a couple of months ago. So it's a kind of a bearish cocktail for the dollar, if you will. But ultimately, I think, it'll run out of steam when we get to that negative net liquidity inflection, starting in the second half of this year.
Thanks, Darius. Yeah, cool. Okay, so the third theme I want to cover before we all go. Alf already had to duck out because he was on a time limit. It's big picture for 2023. So kind of the way I look at it, we obviously had a fair amount of volatility last year, albeit not a proper vol spike. Vol kind of did struggle to get much above 35. Do we anticipate vol to stay elevated, or should we expect some more normalcy in 2023? Right, and the reason I ask that is because from my perspective, the biggest driver of cross-asset vol last year was rates vol, right? And rates, we had the fastest hiking cycle ever. Rates went from nowhere to where they are now. And now, even if rates do continue to go higher up to terminal 5 and a bit, or they turn lower, unless we get a real shocker of a recession with really, really frightened risk assets, we won't necessarily see the cutting as dramatically as we've seen in previous recessions. That's what the market's pricing right now. So I just kind of think if rates haven't got as much room to go up or down, does that filter through to cross-asset volatility, and we see the VIX break below that 18 barrier that it got to, as the lows last year? Do we start to see 15 VIX again, right? That's kind of what I'm suspecting we might see, particularly in Q1. But I'd be interested to know what you guys think.
I'm not, expert in volatility, Imran, but I tend to agree that this year is going to be sort of what I would call like an inside day from last year, where last year, like you said, it was the fastest hiking cycle that the market has seen in forever, and it sent the stock market scattering, right? We saw, oil services up 70%. We saw software down 40% in a year that the S&P is down 16%, which is a pretty big loss. I feel like we're kind of set up for similar directional plays, but because the hiking cycle is not going to be like anything like it was last year, it's not even potentially going to be linear, that all those moves are sort of squashed down, right? And maybe we see E&P and oil services rally 30 or 40% this year, and we see tech down 10 or 15%, and the S&P is kind of nowhere. That's kind of what I'm looking for a number of different reasons.
Mm-hmm.
I will go, and I would say that I back what Tony says there, that I think that the overall theme of this year is going to be the market tends to grind lower and then crashes higher. So we have situations like where we saw the last few days where you get 5 to 10% rallies in a day or two. The VIX will move up a little bit. People chase calls, and then they find out that like whatever the narrative is for the reason they were chasing isn't real, and then that market just fades again real quick. So, historically in the last couple of years, we've had market grinds up and then something bad happens and we'll drop 2-3% and then rally back. I think it's just going to be the opposite, similar to that inside bar idea, right? We grind lower over time because of recession and valuation and blah, blah, blah. But there's still going to be always this impetus to want to chase the upside or not miss that upside rally. And so you get crashes higher, and then those rallies will fade, and then we just kind of overall, continue in kind of a channel lower. So I think I'm with you guys, just the idea that there's no reason for the market to go limit down kind of crashes unless there's credit issues, which I think most of us feel that those aren't on the table right now. And so, it's the upside chase, but it's going to be very sporadic. And the other thing I would just note, which I picked up, which is kind of interesting, and I'd actually be curious on this topic quickly, is everyone seems incredibly focused on what's going to happen today and tomorrow. And you really pick that up anytime you start talking about the VIX nowadays. And not that I think the VIX is this measure that everyone needs to pay attention to, but people think that the VIX looks out too far ahead because it looks over the course of 30 days. And everyone says that's an old indicator now. It doesn't matter. And I think that's so fascinating to me because the big money is going to be made on a position that you make that is out longer than tomorrow, right? And everyone's super high focused on, just this ultra short-term duration of everything. And I think that is going to catch a lot of people off sides that they're under allocated for maybe a bigger move, if and when the Fed pauses and things turn around or whatever it may be. And I was just curious if you guys, when you look at things, if you pick up the same kind of metric or whatever, like on Monday, everybody was like, this is it. Like, this is the breakout of all breakouts. We're ready to go. And it's like, well, the Fed doesn't talk till next week. So it's like, you're just chasing the price action from this morning and not like the longer term picture.
Yeah, the S&P wants to break out above the 200-day moving average, but the yield curve is still buried at minus 75 basis points, and the data sucks. Like, yeah,
Right.
It's definitely a back and forth, man. I totally feel what you're saying, Brent.
It's because it's the casinos open, right? Like,
that's what it feels like, really. Yeah.
I feel like a lot of guys had a terrible year last year and they want to make it up. And so any, price action that's to the positive side, they just start chasing. And then, look, I think Brent's right. We're going to kind of seesaw with a downward bias throughout the year. And then eventually the Fed's going to call, cry uncle. It's kind of what Darius said too. There's going to be a point where they cry uncle and the market has to test them. If you kind of know what the play is 6 to 12 months into the future, I mean, who cares what happens tomorrow or, yesterday?
Yeah.
Because we kind of know the playbook is it's probably going to be wild ranges. And at some point, the bottom's going to fall out of it and the Fed's going to panic. And you just want to buy when the bottom falls out of it. And until then, I mean, I've been focusing on my surfing. I'm thinking of taking up maybe another sport. I'm doing some reading. Like,
I'll go play some pickleball with you.
Like, come on down here.
I will.
Okay, but you say the bottom's going to fall out of it and you're just waiting to buy it. So then, but how come you're not playing the short side then if you think the bottom's going to fall out? Or will you play the short side closer to the time where you think the bottom's going to fall out?
No, I don't short because it seems about, once a month we have one of these crazy 3 to 5% moves where all the shorted names go up 25%. Like, I don't need that in my life.
Okay.
I was up last year. I don't have to produce alpha. And honestly, I'd rather just stay long the trends that are working, which is energy and uranium. And I mean, maybe, uranium's not working because it's not making new highs, but it's not going down. It had massive relative strength all year last year. I just want to be in the things that are working. And I know the other stuff isn't working. And we're kind of in like the 5th inning on this. And I'll start doing my work around the 8th inning right before it gets scary. And I'll probably buy about 2 weeks too soon and cry about it. But now doesn't feel like the time. I mean, we had the fastest rate cycle in my lifetime and nothing's broken yet. And if I know anything about the Federal Reserve, they eventually break something. And so I'm just going to let them do what they do best.
Can I add something on that? Because I think there's one thing we haven't talked about that is that's pretty consensus across Wall Street, particularly when you look at the sell side, that I'm starting to take more and more offense to, which is this concept of this mild recession. And the reason I say that is because if you, again, go back to the starting point, if there's a Federal Reserve that in a recessionary conditions or at the early onset of recession, let's say for 1-2 quarters, they're just going to be sitting there watching the unemployment rate go up and watching people lose their jobs and not responding to that with monetary policy that works on quote unquote long and variable lags. That means when they finally start cutting and finally start supplying the market with quantitative easing, it'll be way too late. It'll be way too late. And so this concept of a mild recession has to, in my opinion, or will by the end of the year, matriculate to something that looks a lot more moderate, could potentially be severe. And I don't mean GFC severe or Great Depression severe, but severe in the order of, down 3 to 4% peak to trough GDP. I mean, this is something that, the Fed risks that outcome if they're planning to sit on their hands once the unemployment rate starts going up. And so I think we need to have a serious discussion about a credit cycle. Now, again, this isn't the GFC. We're not going to break something along those lines because we just don't have the private sector leverage dynamics to support that. We also don't have the financial sector leverage dynamics to support that. But I think one surprise, again, I think if there's going to be some surprises this year, let's start with Wall Street's expectations of, back in hockey stick and earnings. By the way, Q4 sell side has earnings up 10%, or just shy of 10%. Just that's not going to happen. That's not going to happen. So,
Darius,
mild recession, and on that, back half rally, and on that, you're definitely not rallying in the back half with net liquidity, collapsing. So there's a lot of things that we take offense to with respect to some of these consensus views out there. They don't need to be priced in today or even the next few months. But I do believe by the time we get into the middle of the year and it becomes very clear that the outlook for recession is deeper than expected, there will be no recovery in earnings, and net liquidity is going to inflect. I think we will have a kid throwing a tantrum in the candy store, ultimately to get the Fed to do what it wants.
Absolutely, Darius.
Banks aren't allowed. You're not allowed.
I'm not allowed to what?
You're not allowed.
Oh, sorry,
you're
go.
not allowed. Oh, sorry. Go on, Kuppy. No, just saying.
I'll
Banks
just keep
aren't
thinking
allowed
back to 2002
for a deep recession.
I just keep thinking back to 2002. We had a moderate recession, and the equity markets had a tantrum. And every time the Fed cut rates by 25 or 50, we had one of those crazy short covering rallies, and then the market just rolled over the next month and kept melting. And we never had a crash. It wasn't like 2008. It was just kind of like 10% up, 15% down, seesaw. And that was with the Fed cutting rates. I mean, the Fed is still talking about raising rates. We're early in this process. And I know that if a mild recession then, really killed the markets, the same thing's going to happen. I mean, I think you're totally right about this. And they go with a lag, and they're probably going to want to see a few negative prints before they even start talking about lowering rates.
Mm-hmm. Can I add one quick thing to that? Because I 100% agree with you, Kuppy. We've done a bunch of work on this. That 2001 recession that you're citing is the shallowest recession in U.S. history. It was down 30 basis points, peak to trough in GDP terms. And you still saw, if you look at investment grade credit spreads, they blew out to 365 basis points over in that cycle. We're at 149 now. If you look at high yield credit spreads, they blew out to 1,036 basis points over. We're at 420 now. So they're obviously smoking something there in the credit market as it relates to pricing in what we call a phase 2 credit cycle downturn. We just haven't even begun that process.
And people keep saying that, the banks are in good shape, but I think there's a ton of corporate debt that's all bad. I mean, just look at what's happening in all of private equity. These guys, they financed it a year or two ago, and they got okay rates. If they took that credit back to market today, I mean, look, rates are up 400 bips, and they're probably going to be another 200-300 wide. I mean, a lot of those companies are effectively zombies, and the equity is a zero. I think you're going to see a lot of that debt have to get restructured, and there's a lot of it. And I think a lot of the institutional world believes that their private equity investments are money good. And look, if the sub debt's going to take impairments, then the equity is zeroed. And I think you're going to see a lot of pain all throughout the system. So I'm not as sanguine about some sort of financial based crisis. I just don't think it's going to be subprime or U.S. consumer. It's going to be corporate this cycle and governmental. I'd love to know any pushback on that. I mean, Darius, I know you have better numbers than I do on this.
No, so I think you can ruin a career making crisis calls. So I tend to shy away from them. I just rather be positioned for the crisis and tell people to do that. We'll be positioned for the crisis, when we expect. Again, I think it's very clear from our perspective, just given the lags with which monetary policy works, that the Fed should probably be in easing mode today. They're not only not in easing mode, they're in tightening mode still. Quantitative tightening still rolling through. We still got 1 or 2 more rate hikes. It could be 3 to 4, depending on how nominal employee compensation plays out over the next couple of PCE reports. So it's in our opinion, it's clear that whatever economic outcomes that we're going to have are going to be worse than consensus expects and what's currently priced in asset markets. And when shit gets worse than what's currently priced in, that's when all hell breaks loose. And that's when you start to see, gates at private equity. You start to see, capital controls and capital withdrawals, all this stuff. That's when all the bad stuff happens. So, I don't want to sit here today like I have a real clear roadmap on what the crisis might look like. I just know that the probability of having a credit crisis, is significantly higher than anyone's willing to admit, just given the starting point of price in terms of financial markets and the likelihood that the Fed is going to be engaged in tightening way longer than it should be.
Yeah, I agree.
Thank you.
No, thanks for that little back and forth, guys. That was good. So it seems like, the consensus was, well, correct me if I'm wrong, right? But I think the consensus was that, not our consensus, but the market consensus was that the first half of 2023 was going to be tough. Earnings were going to get revised lower. Recession was going to get priced in. The market would sell off. And then you get an eventual pivot from the Fed, which is what the rates market is already sniffing out. And then we get a strong rally into year end, right? I would argue we probably get the opposite of that. We get a rally in Q1, maybe it stretches into Q2, and then get the hell out of Dodge, because this thing is just waiting for the floor to drop out.
We still need to see upside capitulation too. Or don't forget, a lot of hedge funds, not even hedge funds, a lot of investors, hedge funds, retail or otherwise, lost money last year. And so what you can't do is, one, have two bad downtown years in a row, but number two, the number one career risk on the buy side is right toe risk. It's not left toe risk. You can lose money when everyone else is losing money. You just can't not make money when the market's going up. And so if we see a market that spends any amount of time above its 200-day moving average, or at the bare minimum threatens a breakout above that 50% retracement level in this bear market, you're going to see the mother of all upside capitulations. I don't feel comfortable making that call, but I do believe it's a legitimate risk given some of these global growth dynamics that we're seeing, and obviously the starting point of very, very bearish positioning. So that's when you sell. You see any sign of upside capitulation, you sell the hell out of that.
What do you guys think?
I agree with that.
Yeah.
I mean, you gotta chase. The chase can be real and material. If you got a shot at making 5% in a couple of days or 10% in a matter of a week, you gotta, you want to be positioned for that as well. And so that fits in what I was thinking before. Is like these are going to be jumpy rallies, and I think a lot of people are looking at that 4,200 to 4,300 area as like, I can't wait to short that number. Assuming that we kind of get a crack at it at some point this year. I don't know if we get that high because everyone's going to be waiting to short into that. But I am with Darius and somewhat to you there, Imran, as well, that the impetus is going to be, Fed pauses. So like, let's chase. And you don't want to miss that. And positioning will reinforce that rally. But I also think at the same time, like everybody's also waiting to short that 4,200 area if we ever get it. So it'll be quite interesting.
But what about you two, Tony, Kuppy?
I'm flexible, man. I can go either way. I still think it's a year that you got to be super careful being in the right sectors and gone from the right sectors, kind of same as last year. If you're long tech, you're going to probably be wearing it. And if you have no exposure to natural resources upside, you're probably going to miss out at certain points along the year. So it's all about where your money is for me, man.
Mm-hmm. Kuppy, got anything to add?
I agree with Tony. I mean, I think you have a downward bias, and there's going to be a lot of volatility upside and downside. It's going to be a really frustrating market because most investors are trend followers. They're not, mean reversion range guys. And this is a mean reversion range sort of market with a downside bias. And, I know how to play that sort of market, but I'd rather just wait till it all craps out and buy it. So, yeah, I think it's a tough market for a lot of people.
Yeah, so my last two questions, I think you've already answered one of them, is have we seen the equity market bottom yet for this cycle? I think it's clearly, none of us really believe we have, right? And then what are the main pain trades out there that will catch investors off guard? What do we think? What are the big pain trades? Because this market loves to cause a bit of pain.
I mean, I think going back to what I just highlighted is you still have a setup in the beginning of the year where if we're right on our views economically, it's very unlikely that, investors have to price in that phase 2 credit cycle downturn at the start of the year. And if you're not forced by the data to price that in, you get left with a market that has a natural bias to the upside, given the positive net liquidity dynamics we highlighted with the debt ceiling dynamics. And also you have the world's second largest economy with a positive growth impulse that's, aided by stimulus. That's a recipe, in my opinion, for squeezing the hell out of people in the context of a dollar that's breaking down. But again, I don't think it's sustainable. I think this is the kind of market that could get to 4,200. Why not? I don't think it's going that high, but we've been surprised many a times throughout markets, and we'll never stop being surprised. So with humility, I'll say, hey, if it gets to 4,200 or anything beyond that, I mean, that's about as big as a gift as you're going to get as an investor to sell into. And then could we go from 40? We could see 4,200 and 3,200 in the same year. I think that's a very, very legitimate possibility.
Yeah, for sure.
We can see
For sure.
4,200 next week, maybe.
Yeah.
I think on the point of the big pain, though, I think there's been a very clear rotation out of the big tech stuff and into, you know, the more value names or high dividend paying names. And I think that's what's supposed to happen when interest rates are rising. And there's an interesting chart that if you compare just the spread between like Dow and the Qs, that spread is now just back to where we were kind of pre-COVID, meaning that there's still, I think, this impetus to want to chase tech, and I think that is going to be a painful trade, you know, over the long term. Like, yeah, if we're going to rally 10% tomorrow, then that higher beta stuff, tech stuff, is going to be, you know, what you want to like use to chase, I suppose. But if you're talking about investing, you know, I think over the longer term here, you're going to have to put on like more of a value kind of perspective as opposed to, you know, the tech growth, you know, like ARK stuff.
Brent, you took the words right out of my mouth. I see that. I feel like there is definitely some level of downside pain trade in tech, because I mean, you know, I write to and speak to a lot of retail investors, and I feel like they think they just weathered the tech storm last year, and they lived through their Facebook being down, God knows 60 whatever percent it was, their Google being down, their Apple being down, and I think they lived through it. And they're expecting the reversion to the mean just because that's usually how those stocks perform. And so I feel like as we grind lower, there may be a little bit more retail impetus to go, oh my God, am I going to have another 50% haircut in my Apple stock this year?
Right.
And so that's where I feel like there's still downside risk. And I see it as symmetric as the upside risk that Darius just outlaid. So I have no idea what's going to happen first or how it's going to go. But I do see both of those tail risks heavily centered involved in this year's trading.
I guess Tesla's the poster child there, right? So like, I remember Kuppy said that he joined the short Tesla crowd a little while back. Are you still short Tesla, Kuppy?
No, I booked it too soon. I made some good money, but I booked it too soon.
You might get another chance here.
I'm sure I will, but I just don't like shorting. I'd rather just be long.
Well,
it's just such an easier way to play.
Yeah, and Imran, to your point, I would just Imran, to your point, I would just say that, you know, the archetype for this is like you want to short Elon and get long, you know, Warren Buffett. It's like that's not what everyone has wanted to do over the last many years of easy money, right? And and you can see that in the top holdings in the S&P already. It's like starting to flip. Like, what is it? It's healthcare stocks now. It is insurance companies. Like, I think JP Morgan has now cracked the top 10. So it's like this boring stuff that certainly most investors who have succeeded in the last few years chasing tech, like, they're not familiar with that stuff, and it's still kind of like boring, right? But that stuff seems like it'll do better.
Like Batista and Carlos Slim, man, that's it.
Speaking of, I think Mexico's at near all-time highs, right? The Mexican.
That's breaking out. Oh my God,
it's pretty
I'm
amazing.
so annoyed. I told my subscribers to buy Mexico in October. I didn't buy it myself, and it's just gone to the moon. It's so irritating.
Put your money where the mouth is.
Yeah, but anyway, I did on the back of your call on Tesla, Brent, when it was getting beaten up and the whole world was bearish, and you're looking at some of the options flows. I did buy some call spreads on Tesla, but I didn't have the stomach to hold on to them into today's earnings. So I've got out of like 80% of the position just because, you know, I just think retail have like piled back in, getting all excited at the bottom's in. And so I think the risk reward now is probably just goes $20 fast, right? But like, I just, you know, it didn't make a ton of sense to hold on to those, because, you know, sometimes these contrarian trades make sense when the sentiment gets really extreme, and, you know, and often the statistical probability of playing those is very good, but they tend to be very short-term trades.
Yes,
they are rentals. They are not house purchases. They are rentals.
Yeah, 100%.
And that's why options allow you to do that, right? So that tends to be where I operate. All right, guys. Well, I've kept you for a best part of an hour, so thank you so much. This has been an excellent discussion. I think the audience are going to love it. I would also mention that we are doing a Twitter Spaces on Thursday, so that's tomorrow at 11 a.m. So all of you are always welcome. So feel free to jump on if you're not busy. It's 11 a.m. So the market's already going to be open and stuff. So if you want to jump in, say hello, shoot the shit for half an hour. We're going to be doing it every week anyway. So, but I just want to thank you all for being here. Kuppy, it's great to finally meet you, man.
Hey, same. Thanks for inviting me.
yeah,
It's great
Macro
to finally
Avengers.
meet Brent and Darius too. I've been reading your
Likewise,
stuff for a
man.
long time. It's great to finally meet.
I've learned a lot from all you guys over the years, man. It's a real pleasure being here. You guys are awesome.
No doubt. When the fuck are we having dinner together?
Puerto Rico, man.
Yeah,
Puerto Rico trip. Come on down.
Yeah.
Tony, where do you live? What area of the country?
Me?
Yeah.
I'm in New York. I'm in Atlantic Beach, man. The suburbs of New York City off of Long Island. Yeah.
Okay. I mean, I'm in Connecticut, like in Fairfield.
All right. We're not that far away. Double D is up there most of the year, right?
Yeah, I'm upstate New York for 9 months, and then I'm down in Miami during the winter. So I'm leaving on Saturday.
Hey, let's. I go back to Miami a lot. I'll hit you up next time. Let's get dinner.
Absolutely, we'll grab dinner, man. That'd be awesome.
Awesome.
That's a good spot. If you guys do that, let me know. That's 2.5 hours by plane. I can get there.
I would love for that to happen.
No,
Make it happen.
It's about 8 hours.
This is happening.
It is
about
happening.
8 hours for me, but never mind.
Oh, fucking hell. Where are you, Imran? In Saskatchewan?
Nice.
All right.
Great job,
one day I'll come down stateside and see you guys. God knows when it will be. But guys, it's been a pleasure.
Thanks, everybody.
Great job, man. This is awesome.
Next one.